Okay, good morning, good afternoon, wherever you are. Today is Friday, December 23rd. It's about 11 o'clock Pacific time. I'm basically on holiday at this point, so I needed to do this video a little earlier than normal. I know the market's not closed, but it's very, very quiet, and most of the action was yesterday. So we'll talk about that. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. The disclaimers is important to give you feedback as far as what we do here. We're not licensed. I don't make buy, sell, hold recommendations. I can't tell you whether to be a day trader, long-term trader, etc. And the disclaimer will kind of give you insight into how all of that works. Okay, all right. So we'll start with the market thoughts, industry groups, stocks to watch, and then the quote of the week. I don't believe there will be a video next Friday unless something really, really drastic happens. This will be the last video for the year, so I'm going to treat it as such. I'll be out of the office and away from my home next weekend. So it would be hard for me to do a video unless something drastic happens. I can do one if I had to, but I'm going to treat this as the end of the year. So this will kind of be a wrap up video. So let's start with the, kind of the year and how it's done. This was a tweet from the Wall Street Journal. Individual investors have kept buying stocks this year, pouring more money into stocks, the highest on record going back to 2000. So it's kind of an ominous tweet. You can see the money flows on this chart. And I think people have been trained that, markets that go down always come back. And that's been the case since, the low in 2009. And as the market has gone up, it's come back faster and faster. So we had a really short, let me pull up the chart to kind of explain how the thinking behind it and why people kind of get trapped into this. I'm going to pull up a chart of the S&P. So here's the, you can't even see it. It's been so long. Wow. So boy, time surely flies. So here's the great financial crisis, which is really, really bad. That was a really bad bear market. Here is the tech bubble of 2000. That was bad too, but really mostly or especially bad for the NASDAQ. But this was, really one to watch. And you can see here, finally had a correction. I think this was probably 1370 on the high, down to 1074. And I apologize, I should have done this in advance, but you know the drill. 21%. So I guess that's a little mini bear market, but it lasted 1, 2, 3, 4, 5, about 7 months before you were at new high and off to the races. This bear market, although I don't think it qualifies on the S&P, I think the Russell maybe had gone down 20%. A little bit longer in duration, not as far down, but I remember this one. This was tougher. I think like Facebook and all those stocks corrected in this time frame. Then you had this is, I think, what they called the Christmas Eve massacre, and this is the first time the Fed was interested or tried to float the idea of raising rates, and it backfired on them. And so you see it 1, 2, 3 down, and then boom to new highs quicker. So it's making new highs much quicker, and so you almost have to rush in to buy those lows. Then you have the COVID one, which was 1, 2, 3, 4, 5, 6, to new highs. And again, really, this is pretty steep. You might not think that, but that's pretty nasty. And then boom, back quick. This is super nasty, as we all know, and boom, back quick. And so people are trained that, you want to buy it when it goes down because it always comes back. There's an old poker analogy in No Limit Texas Hold'em. In No Limit means you can bet all the chips in front of you. Oops, and that's market's open, so that's going to happen. I apologize, but going all in. When you go all in, most people will fold, right? Because they don't want to risk all their chips on just some random hand. So you can go all in every time, pretty much, and just collect the little bit you get every time, and until somebody wakes up with aces or kings or queens, and then they'll call you, and you'll probably lose. So the analogy is it works every time but one. And that's kind of the analogy for buying the dip. It works every time but one. And that one time it doesn't work will really ruin you, because you'll just keep buying and keep buying. Not to get off track, but it's shocking to me what I see on Twitter when it comes to Tesla. People selling their homes to buy more Tesla. Now, I don't really know if they're really going to do what they say they're doing, but that's frightening to me that people would risk all of that just for a single stock, especially when that single stock is doing nothing but going down. And the mentality is it's because it's made such a big move that it has to come back. And that's kind of the same mentality with the market. So it's been a strange year for sure. It's really been one for the record books. There's been stuff that worked. There's been stuff that's gotten just hammered, and right in between have kind of been the indexes. So let's go back to the slides. So I don't know how this plays out, but in 2000 that it didn't turn out so well. So we'll have to wait and see. This is just a tweet, and I think I will read this white paper eventually. But I thought this was interesting on day traders. And it was Brazilian futures day traders. So take that for what it's worth. But I think it applies across all spectrums. The shorter your time frame, the harder it is to make money, I think, because you lose that magnitude when you get it right. And and I live it a little bit too. I've tried to stretch my holding periods longer and longer in the last handful of years, and I'm not great at it, but it's definitely helped, because the big money is it's not a game of batting average. It's a game of slugging percentage, of magnitude. When you're right, you got to get it right big. I think all of my profits this year are pretty much from being short Tesla, and all the other trades I did kind of washed. Made a little bit in energy, lost a little bit here, made a little bit there, lost a little bit there, made a little bit here. But I had a really big magnitude trade in being short Tesla, and it just took that one. So you need to have some outsized gains along the way. And I just don't think that the back and forth trading, it's just, I know with the zero commissions, it's tempting, but you need to stretch your holding periods out a little bit longer is really what this is trying to say. Now, if you normally hold for days, then maybe you need to hold for weeks. You normally hold for weeks, maybe you need to hold for months, and so on and so forth. This tweet was by Mark Minervini. The source is Ned Davis Research, as well as Bloomberg's Ryan Vlastelica. I apologize if I butchered his name. But the NASDAQ has failed to break its 200-day moving average since April. That represents the longest such stretch in around 20 years. And so just a simple, very long-term trend following strategy can be all you need. It's down below. A rising 200-day moving average gives you an average annual gain of around 13%, and that happens about 3/4 of the time. A falling 200-day moving average gives you an average annual gain of less than almost 1% loss, which is a quarter of the time. So just be a buyer, just be long when the 200-day moving average is rising, kind of what this says. And you'll avoid some of the really, really nasty periods. These are all the targets from Wall Street before the year. So these were their targets for this year, what the S&P was going to do this year. Now it's a target, right? It's not like it's perfect calculation. I don't know how Oppenheimer came up with their number. I don't know how Cantor came up with their number. But the main thing is nobody knows. Nobody knows where the market's going to go. I cannot emphasize that enough. And if we go back to the S&P, you see Oppenheimer at 5,330, BMO at 5,300. You got 1, 2, 3, 4, 5, 6, 7. 7 investment banks at, let's choose Citi as well. So you got roughly 8 at 5,000 or more. You got 1, 2, 3, 4 at around 4,700. And then you have, B of A and MS are outliers. And where did the S&P start the year? So January 1, I think this is one of those most unusual years. I don't think this has ever happened. Somebody said where the high for the year was on first trading day. So there it is, 48.18. So anybody above 5,000, here we are at 3,800. They missed by 1,200 S&Ps. Some of them had the lowest target, I think, was what, 4,400. And even the low guy on the totem pole missed. So you'll see some targets. Some Wall Street will come out with some stuff for 2023, and it's all fun, but I just don't know how they can know. There's just no way to know. The market's ever dynamic and ever changing. That's what I really love about the CanSlim system is the flexibility it allows you. You don't have to make any guesses. You don't have to forecast. You just go with the market. And look, I agree. It's not perfect. People badmouth CanSlim as well. They badmouth value investing. They badmouth it all. So whichever side of the fence you're on, you're always going to badmouth the other side. And every process has pros and cons. Every process, value investing, dollar cost averaging, CanSlim. And I just think it has the best pros with the least amount of cons, because you're just going with the market, allowing it to pull you in or push you out. And sometimes when it pushes you out, it keeps you out. Mostly, you might get in a little bit here and there. And when it pulls you in, it keeps you in. Mostly, you might take some off along the way. But I think it does the best job of doing that. Let's go back to the slides. All right, I thought that was the last one. So let's pull up the indexes and talk about the indexes as we sit here now. So you got above the 200-day on the S&P, broke, got above it. This was the quote unquote good news on the CPI. And that was, I think, in a bear market, which I think we're in until proven otherwise, when you get like a gift, when the market gaps up 4 or 5%, it's just not sustainable. You want to take some off into that. Now, you might have been wrong here if you had done that, at least for a little bit, but now here you are, you sit much lower. So the S&P is below all the moving averages, not acting all that great. The Dow, I was about to say diamond, is above them. I'm not going to worry so much about the short-term moving average, but it's above the two, right? So the Dow has been the leader. And then there's the NASDAQ, which is the turkey of them all, well below and probably testing or going to go below these lows. Today's a perfect example. I think at one point And the S&P was up, not a lot. I'm going to look now just so that I can. So this is very, very rare, but then S&P futures are up 9 and the NASDAQ futures are down 9. And the S&P futures are about a quarter of the price of the NASDAQ. So you see, it's very, normally the S&P was up 9. You should have the NASDAQ up 36, 4 times, right? So it's just really been a really lagging index, and it's just littered with all the stuff that, in my humble opinion, is going lower. That doesn't mean it can't rally, but Apple, Tesla, Google, Microsoft, waterlogged, and no new money, no reason for new money to go there. It's just going to be a gradual grind, sideways to down for those names, and has been for a while. On the upside, you've got like VTV. Now, I've been in this before, and it's interesting to me. It has a yield of roughly 2.5%, but you can see the relative strength is rising. It's 77, which is pretty good for an ETF. It's above the moving averages. DTH, which I do own, relative strength 72, rising. I like this because, well, it's hated. Who would dare want to buy, European equities? But look at the yield, almost 6%. And so I just need, a bit of sideways, and that's kind of what it's doing. It's hanging in there. I think I've mentioned this before. This looks like a double bottom to me. Look, I don't love it. I think the market's in really bad shape, but I think that a lot at the lows. So I want some kind of counterbalance if I'm short, and this seems to be a really good counterbalance. Hasn't hurt me hardly at all while my shorts have gone down pretty good. All right, so that's it for the indexes. Can't think, I guess emerging markets, let's look at that. I haven't looked at, it's just okay. There's just not a lot there. I mean, the Chinese stocks have made a huge move off the lows. They're probably looking at a long sideways action, and I don't know the weighting, but I know there is some weighting for pretty good size weighting for emerging markets. I'm sorry, for Chinese stocks in emerging markets. Let's go to the industry groups. Oil and gas royalty trust, just beating its chest, always number one. Field services, number 2, very interesting. Retail, wholesale, office supplies, solar, losing a little bit of luster, right? You see it's gone from 2 to 4. Contract, machinery, farm, that's Deere. Let's pull this up a little bit. And so not a whole lot that's exciting that tells me, hey, there's a new bull market starting, right? What type of groups normally lead a new bull market? Growth, innovative, big earnings and sales, at least in some of the companies, semis. Now, maybe biotech could do that. There was a biotech stock. I cannot remember. I think it was Madrigal, MDGL. Is that the one? Yeah. So, but there's no earnings and sales. But I guess if you like to buy gap ups, you could have paid 200 and you're sitting at, oh gosh, it went to almost 300. So maybe this could lead. I know Moderna, it's not a great base, big old bottoming base, but at least there is a base with some type of handle here, and holding up, something you could consider as well. So biotech could be the area. I don't know. I'm waiting. I want the market to show me where the leadership is, but there isn't a whole lot. So the industry groups, I don't see a whole lot of story there just yet. All right, so stocks to watch. I talked about the ETFs. Everything that looks good to me, fortunately or unfortunately, is in the same group. It's, I think, drilling. Val looks very good. Look at the weekly chart. I mean, what bear market, right? When you look at that. In the group, let's see what Noble looks like. It looks pretty good as well. PDS looks okay. I don't know. Val, to me, at least that's been my go-to one. Seems like the leader. You remember buying it way down here when, who would dare buy oil stocks? Now I don't still own that position, unfortunately, because that's just not how I do it. But I've been, gone back and forth to this stock a number of times. I currently do own this one. So, and then this group is just acting great. So here's Tidewater, which I bought off the 50-day. First time I bought it here and sold it. It's just what I sold on the way up somewhere in there. That looks very good. I do own this one, Tidewater. Schlumberger, I do not own. Bigger than Tidewater, but looks very good. Halliburton, bigger than Tidewater, probably as big as SLB. Looks pretty good, right? So there is stuff holding up. This one, Weatherford, which I've owned before, and I cannot remember, to be honest with you, where somewhere in here. And then it did this, and I kind of gave up on it because I thought, wow, that's really bad action. But now look at that. And that's why you should never totally give up on them, because there's a couple of times where I had a chance to buy this and had kind of given up on it. I think David Ryan mentioned this one on IB Live, and I pulled up, I was like, oh my gosh. So this one looks very good. And this is in machinery equipment. And I think is 9 is another stock. Oh, it's field services. So this is not a stock I've ever known. I think somebody mentioned this on Twitter. And wow, look at that. It's just from now it is $4 stock, which is why I've never owned it, never seen it. But this I don't mind buying like this as they come off the lows after a big move. The risk reward is very good. If you pay 9 and change, you risk 5% and you're up, 35, 40% if you caught it. I do not own this one. So there are stocks to own. There are areas to own. Not my favorite group, but it's holding up. So here's a gold miner, relative strength 97, coming out of a long base. It's never seemed to keep going. That's the problem I've always had with gold, right? Breaking out and stumbles, and like Newmont, I think early this year. Is this early this year? I feel like, oh yeah. So early this year, breaking out, didn't work. And then, I'm sorry, early this year right here, breaking out, didn't work. So they just never seem to work, which is why I can see the macro. I can understand why people talk about gold and why it should go up, but it doesn't go up. So something's not right. And so if it ever does go up, maybe I will participate a little bit. I'm always been a bit skeptical of it because it just in the last 10, 15 years, it just hasn't worked when people said, oh, it should work, but we'll see. So there are areas of interest. Just keep doing your work, do your relative strength screens. And who knows what 2023 will bring us. I don't know what groups are going to lead. I think it's going to be energy. I do, but it's because it's real early. If it's a bull market, like a secular change, what are we, a year in? It's just nothing compared to what some of the consumer cyclicals like, or consumer discretionary, I should say, like Amazon, Apple, Tesla, if you consider that consumer discretionary, how far they went, how long they went. But I need more proof at this point. All right, so let's go to the quote of the week. And I have two, because I had one for next week and I couldn't decide which one to use. So I said, let's just use both. Scott Bessent, he once worked for the Soros Group. He's, I think Key Square Group is probably a hedge fund or a family office or something, but when he was talking about, and I have a typo, I apologize, but he said when he goes to, these dinners where people talk about their favorite stocks, their attitude was, it doesn't matter what's going to happen in the world because their favorite stock is generating free cash flow. It's buying back shares. It's doing X, Y, Z. And when I read this, all I could think about was Tesla, because that's all I hear about, how they're doing this, they're doing that. Here comes a buyback here. Now it's a value stock with big free cash flow, but they forget 50% of a stock's move is the overall market. Where's the overall market? Down, especially in the NASDAQ. 30% is in the industry group. What's the industry group doing? Now, is it EVs? Is it cars? Is it technology? EVs are slowing maybe a tiny, tiny bit. Or if they're not, I do know that because I'm in the market for a used car for my daughter, and the used car market is finally crashing and burning, coming down fast. CarMax, I think, is down a bunch. So the industry group is no good. And then maybe 20% is the extra alpha from the stock picking. So 80% of Tesla is swimming upstream big time. And the other thing about these numbers, I think it almost coincides exactly with what Bill wrote, in 1988. So there must be more to it than, he just didn't pick these numbers out of a hat. And look, it's probably not exactly 50, 30, 20, but it's close enough for government work. So that's why we look at the market. That's why we look at industry groups, because they're a big, big factor in whether the stock you're looking at is going to work. Stanley Druckenmiller, who's the GOAT of big money and returns. When you combine returns with AUM in the billions, I think there are a few, maybe Simon's at Renaissance, but he's not discretionary. He's at least, well, I guess when you program the computer, you are telling the computer a little bit what to do. It's neither here nor there. He's on, let's just say everybody knows Stanley Druckenmiller is. He's on the Mount Rushmore and of investing. And he says the queen in chess, this is a quote I'd never heard before, which is surprising to me, but it's so simple, but yet so complex. The queen in chess, which can move in all directions, is a far more powerful piece than the pawn, which can only move forward. So you have a big advantage versus like a mutual fund, which can only move forward. They can pretty much only buy. They're always fully invested. I guess they can retreat a little bit with reducing positions or selling stocks, but they have an anchor tied to them. Whereas you, if you're running your own money, your account's like a queen. You can go forward. You can go forward a lot. You can stop. You can go sideways. You can go backwards. You can go backwards a lot. And that's why that piece is so powerful. And that's why having that flexibility to do that is such a big advantage for you. You can be short. Now, a lot of people might not want to be short, but that's okay. You have the ability to be short if you want. And maybe if you don't want to be short, being 90% cash or 80% cash is the equivalent almost of being short, because everyone else is losing on the being 100%, fully long. And so you really have to take advantage of being flexible and open and moving in all directions. And I try to do that almost every single day. I have a thesis. I think XYZ is going a lot lower, but if I get information that I'm wrong, I've got to recognize that. I think XYZ is going a lot higher. If I get information that I'm wrong, I got to recognize that. And so I'm treating my portfolio like a chessboard, moving the pieces around, attacking, retreating, etc. And on my chessboard, they're all queens. I can do that with every single position. What a huge event. I think I'd be the greatest chess player in the world. If all my pieces besides the king were queens, I think I could be don't you think I could be the greatest? Anyone out there would probably be the greatest chess player in the world. That would be a great experiment. I can't remember the guy's name who's considered the greatest chess player in the world, but I saw he beat Bill Gates in about 90 seconds. And so I wonder if I could beat that guy if every piece I had was a queen. That would be very interesting. I'm not a very good chess player at all, believe me. But the power of those pieces, I think, would be insurmountable in that regard. All right. Well, thank you guys. Have a great holiday. We will see you next year. Highly, highly unlikely I don't do a video next Friday. But we'll be back in full swing of things come 2023. Marcus Smith at investors.com, 800-424-9033. Thank you, everyone. Bye-bye.